Today, we're going to be talking about the 10 investor biases and what you can do to mitigate it so that you don't get yourself into trouble. John, it's great to be here with you.
So good to be here, Mark. Yeah, it's an exciting time. It's start of a new year. A lot of stuff in the headlines, right? A lot of political stuff, but it's something you and I've talked a lot about on this podcast. One thing I love about this business is that, you know, uh, typically real estate, but specifically housing, is not impacted as much by the political climate. Right now, interest rates could be impacted, various things of that nature. So but all that to say, what we're seeing in the marketplace, I know you had a really great conversation with one of our trusted advisors, Dugan Kelly, who's our securities attorney. We're talking to a lot of lenders. There's going to be a lot of opportunity, I think, this year for well positioned operators like us that have a solid buy box and business plan and capital raise strategy because the reality is that there are a lot of deals that have either already been restructured but aren't able to refinance. And so what we're hearing is that a lot of the banks are going to start saying enough's enough. So we've already started to see some really notable increase in opportunities. Really specifically, we're recording this around January 21st, so this episode may air in a few weeks. But this is the week we have historically started to see deal flow really start to pick up after sort of the post-holiday hangover. So we've got a few deals we're looking at already. So regardless of the political climate, I think we're going to have some great opportunities for our investors here real soon. So I'm feeling good and excited. How about you?
Yeah, well, talking real estate in today's market, it is not the same climate as it was back in 21 and
Yeah.
beginning of 22 when everything was hot, real estate was sexy. And, your friends and family, when you said you were buying an investment property, were like, wow, that's a great move. And what's interesting now is that now that we're starting to hit the bottom in the real estate market, the conversation's totally shifted and to the opposite side. Like, real estate, it's not, it's just risky, it's not sexy. I know people who lost money. And so it's really interesting, all assets go in cycles, right? There's
Mhm.
ups and downs. And so with real estate is no different, and especially in the multifamily space, where these assets at 21, beginning of 22, you couldn't even get your hands on them. And even if you did, you were paying such massive premiums to be able to find these cash flowing properties. And so now with pricing coming down, John, we are seeing more and more great opportunities. And based on that conversation I had with Duke and Kelly, as you mentioned,
Yeah.
and he's our a securities lawyer. It was interesting. He was excited. He's like,
Mm.
man, you guys are going to see a lot of deals coming down the pipe this year. And
Yeah.
so a big part of that is lenders are being a little bit more aggressive with the operators that have been holding on for dear life. And they're saying, okay, let's get these off the books right now. And so there is, we'll just say there's influence happening there, and this is going to be very good for us. So where we start to see more deal flow is in February, March, April, May. Like once we get through this January month, we are starting to see more deal flow, as you mentioned. But
Yeah.
it's going to be an exciting year for sure. And we think that anything that we purchase in 26 in 28, 29 is going to be, we're going to be looking back in 26 and like, man, that was a very good opportunity. And we'll just have to do another episode, John,
Yeah.
in the future of what those fundamentals are to be able to talk a little bit more about why we think it's not only the bottom of the market, but such a great buy opportunity today.
Yeah. And gosh, this conversation we're about to have around bias, right? I mean, it's that idea that in 18, 19, and 20, when the market was overheated, right? Like there was, maybe a lot of social proof in a sense. Maybe you had friends and family that were diving in and investing. And, sort of sometimes you have to go against the crowd a little bit, right? And I almost overuse this. I probably said it on this podcast 20 times, but, Warren Buffett, right? When everybody's scared, get greedy. When everybody's greedy, get scared. And these biases do come into play here, and one we'll talk about, right? The recency bias, right? To your point, unfortunately, there were some people that bought into a good deal, but didn't recognize the cycle and that it was the end of this peak cycle, right? And so, because of that, there's now some cash flow challenges because if it was floating rate debt, that they can no longer cover the debt service because the rates tripled, right? And so, some of the things we'll touch on here at the end of the podcast is how we work to preserve and try to mitigate risk, right? You can never eliminate it, but how can you mitigate it? And we'll get into that. But these biases are going to be important for any investor who's considering investing to just be mindful of and to think about, right? And make sure that they're not falling into some of these thought traps, right? I've read a lot of books on this stuff, and the human brain always looks for shortcuts, right? And in some ways, it's very powerful, right? Pattern recognition. It's like I've seen this before, and it's that gut instinct, and you kind of can make a fast decision. But when you're making a big decision like investing capital into a deal, it's really good to slow it down a little bit and really analyze your thinking and not just rely on gut instinct, right? And
Yeah.
so those are some of the things we'll be talking about today.
Well, and when it comes to this, one of the best guys to follow is Robert Cialdini. So he wrote
Yeah.
a couple of books that were phenomenal. So Influence is one, and Persuasion's another, where he talks about, like, we are wired, like you had said, that we have shortcuts, and so a lot of these biases we're going to be going over are examples of that. So we have 10 of them here. So this is going to be we're going to go through these fairly quickly, but we're going to make sure that you have a really good understanding to not only know what these biases are, but then what you can do to help mitigate and to check yourself so that the decisions when it comes to investing your money, you don't get caught up in the hype
Yeah.
and you're able to make a wise decision. That's actually one of our core values is making wise choices or wisdom.
Yeah, that's right. So the first one, right? FOMO, fear of missing out. You can also maybe refer to this as herding, right? Going with the crowd, right? So everybody's in this hot market. It must be safe. And that could be talking about the overall market, right? So it could be an asset class that's, got a lot of tailwinds that are working in its favor, or it could literally be in a market, right? Or a sub market that you're thinking of investing in. And when you're in these cycles, you discuss, right, where, and we've had a whole episode on just what these real estate cycles tend to look like. But a good example is, oh, this market is hot. I recently exited a deal and made a really incredible return, but you're not paying attention to the supply wave that's coming because operators and developers noticed that and then started snapping up land to build more, right? And so if you're not, if you're just following the crowd and not digging deeper and looking 3 to 5 years ahead at what may be coming down the pipe, right, you could end up in a situation where, you bought at the wrong end of the cycle without meaning to. So that FOMO is a big one.
Yeah, and this is actually a big one now for you're seeing this in the equities markets where
Mhm.
you're seeing, oh, my friend got 15, 20%, returns and oh, I need to go into it now. So really looking at from a cycle standpoint, all markets go up and down, right? So when
Mhm.
it's at its top, it feels like it's the best time, and when it's at its bottom, it doesn't feel that it's the good time to invest. So a couple of things to do is actually just before you actually just jump in, to pause and ask yourself, like, why this investment, why now, and am I getting caught up in the hype, or are the fundamentals still a very good time to buy? One way to look at this is there's a very well known approach to investing, is they call it like dollar cost averaging. So
Mhm.
investing all the way along, and not just, okay, I'm going to invest at this time all in at once. It's like if you do it throughout, you're going to be able to buy into the market, buy into a down cycle, and then buy in an up cycle as well. So spreading it is another good way to overcome this herding or FOMO.
Yeah, that's right. Next one is recency bias. So, that shows up like, well, my last deal with this operator went really well. So the next one should go really well too. And largely speaking, like a really talented group of operators, are likely going to produce similar outcomes. But each deal needs to be looked at with a totally fresh lens, right? And we've seen that with even some of our investors where, for one reason or another, perhaps they just don't like a certain submarket that we're buying in, or really more generally, the market we're buying in. So, we have a handful of deals in Charleston. And so we had some, investors that love us, invested in multiple deals and just said, I'd love to invest in another market. I want to diversify the locations a little bit. So that's a good example of them, rejecting that sort of recency bias and saying, for me, I like diversification. I like you guys, but I'm gonna wait for the next deal that's perhaps in a different market. So, I've got some money invested in Florida, some in South Carolina, some in Georgia, spreading the risk a little bit across multiple markets. So it could also just look like, I invested in this asset class and it went really well. So I'm going to continue to invest in that asset class. Could also extend to things like stock. I mean, AI is kind of the hot thing right now. But if you look behind the curtain, I mean, I just read an analysis on ChatGPT at their current subscription growth rate and their current revenue rate, they'll lose $8 billion this year and $15 billion next year. And so not saying ChatGPT is going away, or OpenAI, I should say, the company, But you got to watch these things, right? So just because it's hot, right, or it's had some good runway. I mean, Nvidia is a great example. I did invest in Nvidia, but I divested because it just felt like it was too volatile.
Mm, yeah.
I'm not trying to hit home runs here. I'm trying to hit a lot of base hits with my
Yeah.
investing, right?
Yeah.
Home runs, sometimes you hit a lot of foul balls if you're not careful, right? So yeah, recency bias, just something to slow down and just look at each deal with a fresh lens. I think I'll
Yeah.
leave it at that.
For sure. And this is where we're going to go to the next one is confirmation bias. It's you've already made up the decision in your mind and you start looking for things to be able to back up that decision that you've already made. It's
Yeah.
really interesting. This is such a powerful bias out there. And actually, silver is a really big one out there now, John, where we're seeing like a big spike. You're like, wow, it's going up. And then you make a decision. A lot of times it's unconscious, that decision that you made it. And then you start doing your research, but you're only looking from the one side. So a good
Right.
way to protect yourself is to actually try to create a case against it
Hmm.
as well, and to find three different credible, we'll say, reasons or publications or data points to be able to go against it. And it's very hard to do because
Yeah.
you've already made up your mind and we all want to be right. And so confirmation bias is something you really need to watch for when you're making especially larger investments.
Yeah. One technique I learned about a long time ago, and I'm sure you're familiar with, but Benjamin Franklin had this, he called it like a morality test, but it was a pros and cons approach where he would just create a simple T chart and just write all the pros of a decision and force himself to create the same amount of cons for that same decision, right? And have to dig in and do the research. And it's like almost create like an internal debate with yourself where you'd have to sit there like, my daughter's actually in debate club. And it's like, sometimes you have to argue a point that you don't agree with, but that's the point, right? You have to teach that critical thinking. So that Ben Franklin T chart pros and cons is a good approach there. It's interesting with Silvermark. We actually have provided as an investor gift some really neat, stamped, for the asset silver pieces, and our vendor's saying he can't even buy silver right now because nobody's selling, everybody's hoarding it, right? And so, that's an example where I'm going, I'd watch that a little bit. That seems like greed and maybe like not critical. That might just be confirmation bias
Yeah.
happening with some of these investors. So no
Well,
doubt
and
about
that
it.
it was funny because on the one, it was like those coins, they were
Yeah.
doubling. It was like, holy geez, like all of a sudden the gift number was going up. Is
Yeah. Yeah.
so it was because we started buying it for anyway. So
Yeah.
it is
Yeah.
interesting, and that's generally it's what like when everybody's jumping in, you just
Yeah.
gotta check yourself. It's generally when we'll say the tides are coming in really strong, say, and it's pulling
Hmm.
you in. It's like you gotta just slow down. I think
Yeah.
that's the big one. The next one is this idea of loss aversion. So not investing because I don't want to lose money, and he's just kind of you
Yeah.
don't take action at all. And so maybe you were stung in the past. And so this is where to really look at what happened in the past. Why did I lose on that? Where are we at in the
Hmm.
market cycle right now? And is this a good time to invest? And this is where having an overall thesis of these are the types of assets, this is what I invest in, and here's how I stay conservative with it, and still continuing to invest along the way is really what's going to learn. You're going to win over the long term, because there's sometimes you do lose in investing, but as long as overall you're going in the right direction. I mean, stock market goes up and down as a good example, right?
Yeah.
It's like the only time you really sell or you really lose money is when you sell. That's when
That's
you
it.
lock it in.
Yeah.
So continuing to invest along the way in a down cycle where it looks like you've lost, but as long as you keep playing the game over time, you're going to do extremely well.
In fact, I had a friend who bought Open Door shares of stock at $16. It went down to 50 cents at one point, but he believed in the company over time. He would buy a little bit more. He was telling me he was kind of wondering if he was making the right decision, but now his dollar cost average is $6 a share and it's up to 13 again. So, that's an example. He believed in it. He just felt like there were some things that, were unfairly, contributing to the stock price. And that doesn't always play out. So I'm not saying to take that approach all the time, but there's an example, right, of just continually investing in something you believe in, and it catches up. That next one is the overconfidence or sort of like illusion of control, and this is one that applies to operators just the same, right? We can't always control rates and exit cap rates and things like that. So if you're thinking of investing, you should be favoring operators who are using fixed or cap debt So there's no, sort of guesswork on where rates might be and how that might impact the investment in the future. Candidly, a lot of the operators that are in trouble right now, kind of those operators our attorney Dugan was sharing with us that are in trouble took floating rate debt. And so that was a lesson we applied immediately, said we're just not going to do that, right? Having strong reserves in place, having cash in the bank. You and I always talk, Mark, cash in the bank is oxygen, right? Having those reserves ready for a rainy day and making sure we're only buying deals that are already cash flowing on day one. So we're not, sort of praying and betting that we'll fix a troubled asset. We're getting an asset that's performing, but perhaps underperforming in ways related to its management or, kind of the quality of the units, right? Things we can easily fix and control. So making investments decisions based on things that are truly in control of the operator and as yourself as an investor.
Yeah, for sure. And this is where it's interesting. Jim Collins talks about this idea with building businesses is this idea of healthy paranoia.
Yeah.
And so always asking like you could be, actually could be wrong. And so if you get this overconfidence, I can never be wrong. Uh, Generally it's like pride comes before the fall.
Yeah.
That's a proverb from
That's right.
Solomon. And so this idea of not being overconfident, being able to have the right strategy and just following it through, that psychology and money was really good in that message that is just about consistency, and then it's having the we'll say the resiliency in a down market to just keep going in following your plan, and then not getting caught up in the hype with this
Yeah.
overconfidence side of it. The
That's
next
right.
one is this halo effect. So this is where you see something shiny. Maybe it's like a friend. And listen, I've been caught up in this in the past, is where a buddy's like, "Hey, listen, this is the next stock. You need to, this is great." And you go in on it, and you realize, oh man, that was just that. Like I just got caught up in the hype.
Yeah.
Or maybe you see some marketing, or you see some sort of promises out there of like, wow, that would like totally change my life.
Yeah.
And the reality is you want to make sure that you understand the business plan, you understand exactly what you're getting into along the way, and you don't get caught up in this idea of, it just looks good from the outside, but then when you peek under the hood, you realize there isn't a lot of substance there.
That's right. Yeah, sometimes, I think about some of the influencer culture, right? There's some folks out there that, put out some really great content. It's really shiny. They're attractive characters, right? But, you have to look beyond that. What is actually in the deal deck? What is the 90-day plan? What are your KPIs? Like, what is the stress test that you've accomplished or put into your underwriting? So, next one is sort of the familiarity bias. So, the idea like, I only invest locally because I know that market. I'm familiar with that market. You could also call this the home bias. And so, looking outside, your comfort zone of familiarity, right? And it's where, a lot of our investors are actually living that because they're investing in the United States. And for many of them, that's new, but they've seen the opportunity, right? They understand that the United States just has some things that, can potentially make these types of investments more attractive. Not all states are created equal, but when we're investing in states that are landlord friendly, allow us to move quickly with problematic residents, have huge population growth, diverse economies. But we have run into some investors like, I just like investing close to home, and that's okay, but you may miss some opportunities. So being able to look outside your sort of familiarity and your comfort zone and, running that analysis just the same. But for example, I mean, I'm 20% of my stock portfolio is invested in international companies, right? Like I could just say, well, I'm a USA, I believe in the USA, but there's a lot of great companies in other parts of the world and growth is happening there. So being comfortable with, stepping outside of your familiarity.
Yeah, 100%. And this is where it took me a long time to actually figure this out. Being a real estate investor, north of Toronto is
Yeah,
just, I didn't even think that that was even a potential to be able to invest outside. I just didn't know how to do it back,
right.
a decade ago. And that this is where it really was educating myself and then seeing and truly diving in. Okay, what are these other markets compared to my local market? And then when I started doing the analysis, it's just like it was very clear. And then from there, the next step was really making sure that we had the right team, the right execution to be able to take advantage. Because there is, on the flip side of that, you do need to be careful when you go into a new market that you know the ins and outs of that. So when you are venturing outside of that home bias, decision to move outside, you want to make sure that you have the right counsel, the right
Yeah.
advisors along the way to be able to help you so that you don't make a mistake on that side of things.
That's absolutely right. Next one is present bias, right? So, maybe just picking the investment that is maybe most advantageous on the front end. So perhaps it's just a larger preferred return on a monthly or quarterly basis versus looking at the total return and even looking at maybe perhaps the tax benefits that this investment will bring. So, you have to really do a deep dive into these deals. There are some investors that are looking for that higher, preferred return, partly driven generally by the season in life they're in. They're looking for that sort of predictable cash flow income, that passive income. But it's important to look at the total picture and the total package. What are the total returns? What are the potential tax benefits? And how could this, help me reach my ultimate goal? So, compare after tax, look at the equity multiples across deals. More sophisticated investors are often looking at the internal rate of return, to compare investments. But, it goes back to it's kind of the common thing here, like really, looking under the hood and getting into the details, not just, the flashy items at the front of the deck, so to speak.
Yeah, right on. And number nine is sunk cost fallacy. So this is where you've already spent X amount of dollars in an investment. You're like, oh, I'm so far into an investment. I'm going to keep going. I need to try and protect that first dollar. And so it becomes really important as you're going along to really, decide when's the right time to cut it and to just say, you know what, okay, I'm going to move on. I'm not going to put a good dollar after trying to fetch a bad dollar, so to
Yeah.
speak.
Yeah.
And so this is where slowing down and actually looking at it and say, asking yourself the question, if this overall was a new investment and here's the upside in this, is it worth potentially losing this new dollar? Or can I put in
Yeah.
another investment, and get a higher return in another investment? So slowing down at that time that you're putting in more dollars is really going to protect you in the long term.
Yeah, no doubt. And it's one that can catch you in a few different spots, right? So, you and I have both shared examples where, not so much in investments, but maybe a thought in terms of like an idea at one of our businesses, and you get so far down the path, but you get a little gut feeling that maybe we shouldn't be doing this, but it's like, well, gee, we've invested this money and time, right? So, sunk cost fallacy shows up in all areas of our life. So it's something to be super mindful here. And the last one is the narrative fallacy, which is, basically just falling for a great story, right? So things we look at when we're making an investment decision are obviously things like job growth, population growth, livability. Are there access to high quality amenities in that area? So, even simply think like proximity to grocery stores or say Target or Costco or some of the, shopping areas that people would want to, be at. And so what can sometimes happen is, for example, maybe a big project gets announced. So, for example, we had already invested in Largo. So this was in no way, shape, or form part of our decision making. But around the time we closed, there was this conversation around redeveloping the Tampa Rays baseball stadium and was getting a lot of headlines. And guess what? It hasn't come to fruition yet. We're 2 years past that headline, right? So making sure you're not just like, oh, wow, then operator's telling us this great new thing's happening or is planned. A lot can happen in development, right? They can lose funding, maybe the zoning doesn't get approved. So, really look at the fundamentals that are provable and real, not necessarily, what may happen in the future. And in that context, I would look at that to say if the fundamentals are still strong and in that example that stadium comes, then that's just like gravy, right? That's like icing on the cake. So, still making the decisions not on the headline. You got to separate the story and really focus on the math. And once again, basics, right? Rent comps, tax and insurance quotes, lender terms, like what are the real fundamentals of this deal? What is the organic rent growth, right? What does the after renovated rent growth look like? Those are the key factors, not the headlines.
Right on. So just to recap, so we have FOMO, recency bias, confirmation bias. We have loss aversion, overconfidence, halo effect, home bias, present bias, sunk cost fallacy, and the narrative fallacy. So what can you do to help mitigate, just to tie up this conversation? So first, you can create a set of rules when you're investing to be able to mitigate risk. So Like one of the rules for me is I only buy properties, I only invest where it actually provides cash flow for me.
Yeah.
Like I love cash flow. So these long term where there's no sort of cash flow coming back, it's riskier. Another rule that we have, Fair's Capital Partners, we buy properties within a certain age time frame as well, and we want to make sure that we have X amount of upside potential that we can go in and we'll just say go in and add a lot of value to the property. And so by having these rules, fixed debt is another rule that we have. And so if you set a set of rules for yourself, help, it'll check you when you get excited about the next investment. The next one you want to do is ladder, you can do here is ladder your commitments as well. So what I mean by that is when you're investing, instead of going all in on one, you can actually spread it out from a time frame. So if a market's going up or down, you're going to get that dollar cost averaging effect. And then you could have your like non-negotiables as well when it comes down to, listen, no matter what happens, I'm not going to do this.
Yes.
And so John, can you think of anything for yourself there where it's like, listen, I have a rule, I just or like a non-negotiable, even if it's really good, if it's part of my rules, but this is like an absolute, I'll never do this for you. Do you have one of those?
Yeah, I mean, it's funny. I hadn't. Yeah, I mean, one that comes to mind is, sort of like, for example, car washes. I think that's a great example where the past few years there's been an explosion in the car wash industry that's led to a lot of great outcomes for investors because basically they figured out a subscription model. And frankly, I go to one once a week. It's like a ritual. Every Sunday, I go get my car wash and vacuum. I pay $40 a month for it, but these are the types of things that when a recession occurs, people start to cancel, right? And so, for me, that's the kind of investment that it seems great on paper, seems shiny and wonderful, but guess what? There's one that I go to now. There's like four others, like on every other street corner, right? So I think that oversaturation. So that's a more recent example, but I've been pitched a few of those opportunities and turned them down. Even though I love the product, I just don't look at it as a strong predictable investment. I think that there are some concerns with some. So that's one that came to mind. You asked the question is the first thing that came to mind.
Well,
How about
and
you?
and yeah, for there's another one too. Like you could have for X amount of cash in the bank, or
Oh,
I
right.
never
Yeah.
get go over from a leverage standpoint, where it's like, listen,
True. Yeah.
this is like a non-negotiable when it comes down to investing. So very similar to the rules side of list that you have, but then there's others that are like, listen, I just don't do that
Yeah.
overall. So it's a little bit of a stronger side. The next
Exotic
is
loans would be another example for me, Mark, right? Kind of
yeah.
unusual bridge debt that, seems all great, because it's got a low kind of in cap or, mortgage rate, but it could triple, right? So that would be one for me for sure. But yeah, sorry about that.
Yeah, next is just insist on transparency. So if something doesn't make sense, you're not getting the data points to be able to um, make a wise decision and get the full information. Then I just pause and just wait till you get it. It's very easy to start getting, we'll say, pressured into making a decision. So getting that transparency first, getting all the data points, and then making the decision is really good. And last but not least, here, when it comes down to an investment, if you had invested in the past and 24 months later, a couple of years later, it's like really looking at, okay, how is that performing? And is this something I want to continue doing moving forward? And can I do this even in a different way
Yeah,
to make it better? This is how, John, you and I run the
that's
business
right.
is each and every day as we're looking at how can we do things better? Each and every
Mhm.
deal when we close, it's like, okay, how can we do it better? And small improvements over time. And it's the same with investing. Small little lessons taking action on over time compounds into big results.
That's right. No, it's been a good talk, Mark. I think these are biases that if you're thoughtful about, and really that last 5 minutes, I think there is the most critical component. Really creating a framework for your investment strategy, looking at those non-negotiables, the things you're just not willing to do, and looking for things beyond the deal deck, right? Like really doing your own research and a little bit of your own due diligence. Number one factor: partnering with operators with a track record of success, like Faris Capital Partners.
You got it. Well, thank you everyone for listening. If you enjoyed the show, you can go ahead and subscribe to the channel. If you are thinking about investing in real estate, you like to find out a little bit more about what investing with us could look like, go to fulloutinvesting.com. You're going to see a sample deal and a little bit more about why we believe multifamily investing is a very, very strong, reliable, secure investment that over time gives not only excellent returns, it gives cash flow, and it gives a lot of stability in your investment portfolio. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.